With oil currently above $73 a barrel, President Trump is turning up the heat on OPEC, telling the group on Twitter to reduce pricing now. Iran's OPEC governor responding, quote, "Your tweets have increased the prices by at least $10. Please stop this method." There are some key things to understand about rising oil prices. First, OPEC can't increase production without breaking the deal it's already made. And second, some OPEC members simply can't raise output. Third, Libya's supply disruptions are causing concerns, but it's not just OPEC. Canadian output is down as well, and continued issues with trucking and pipelines are slowing production in the U.S. Permian. So what does this all mean for the oil market? Joining us now, Helima Croft, Global Head of Commodity Strategy at RBC Capital Markets. Helima, great to have you with us. This is a strange brew that you have to sort of figure out. But what does this mean in the short term for oil prices? Is a path of least resistance higher or lower at this point?
I mean, I think the path of least resistance is higher simply because this market is tightening. I mean, President Trump continues to tweet, but there's really not a lot that OPEC can do in terms of putting additional barrels on this market rapidly. The Saudis and the Russians have pledged to increase production by 1 million barrels, but that's going to take some time. Other countries like UAE have also said they'll put a couple 100,000 barrels in the market. But again, that's going to take some time. And as you pointed out, I mean, Libya is now down by 850,000 barrels because of problems with their eastern ports. We have Venezuelan production continuing to drop, and we haven't even had the Iran energy sanctions kick back in yet. And so this market has significant supply disruptions, and it's a real question of who can put barrels on the market right now.
When is Syncrude supposed to get back in line in Canada, and could that provide some relief even at the margins to oil prices here?
I mean, we're looking at a potential, some time of restart, over the late summer. But the problem is that's 360,000 barrels. And you compare that again to what we're seeing in Libya. We're potentially looking at, by the fourth quarter of this year, being down 700,000 to 1 million Iranian barrels with these sanctions kicking in. So, yes, Syncrude would help, but these other outages are so large that it's going to still be a tight market. And again, I don't really see what OPEC can really do to help out at this point.
The president blames OPEC, says the OPEC monopoly must remember that gas prices are up and they're doing very little to help. If anything, they're driving prices higher. And he concludes by saying, reduce pricing now. Does he fundamentally misunderstand the nature of markets, that they're set by supply and demand, and that the issue really is supply?
Well, I think at this point, what he may not be understanding is that the OPEC countries that can do more have promised to do more, but they can't rapidly turn this on. It's not like flipping a light switch. And as long as Venezuela continues to drop, and as long as he is still, intent on imposing such large sanctions on Iran and really trying to take Iran out of this market, this market will be tight. There's just not a lot of extra barrels out there to deal with these supply disruptions, and the demand outlook remains strong. So we are just fundamentally in a tight market. Now, he could put efforts on resolving the Libyan conflict. That would be potentially something significant. Or he could issue waivers on Iran sanctions and sort of slow walk the implementation of those sanctions. But if he's going to try to take Iran out of this market, there's no way around the having potentially higher prices.
We hear a lot about bottlenecks or the inability to transport oil that comes out of the Permian to refineries and then to end users. How intractable and long-term is a problem is that, or can it be solved relatively quickly? Do you expect it to get better?
Well, we're expecting relief, but we're expecting relief at the end of 2019. So again, this is not going to solve anything in the near term. That's why we think as we get closer to the midterms, we could be looking at a release from the Strategic Petroleum Reserve. I think that is what Trump will have to turn to if he wants to shift sentiment. Now, there'll be fundamental issues with that in terms of the type of crude grades in the SPR. Our refineries are running basically flat out at this point. But I think that's one of the remaining bullets to bring down prices if he really wants some type of, sentiment shift going into midterm elections.
Helima, do you think that the president would look at tapping the SPR in a much quicker fashion than perhaps other administrations have looked at? I mean, that's a pretty serious thing to consider.
I mean, it's a very serious thing to consider. I mean, technically, you're only supposed to use the SPR when there's a disruption to a U.S. refinery, not to bring down prices. But again, as long as he continues to see this as a very big issue for himself in terms of gas prices, and if OPEC can't put additional barrels on the market, I think SPR may be something he turns to quicker than other administrations just for a psychological reason, trying to get the price lower, even just in a temporary fashion.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.